You can get mortgage rates of 5.75% and even 4.75%. Yes, now for investment property, even though there's 7 or 8% elsewhere. By the end of this video, I'll give you those details. But first, I'm Keith Weinhold. Today, in my exclusive interview with housing intelligence analyst Rick Sharga, it's part 2 of 3 here, you're going to learn about plummeting home sales volume and direly low home inventory. Why exactly is home price appreciation taking place right now? And a lot more straight ahead. If you like these topics, go ahead and put a like on the video here. We're talking with Rick Sharga, expert housing analyst. Previously, we talked about the general condition of the economy, and now Rick and I are going to break down the housing market with what's happening there.
Yeah, and they're so definitively connected, Keith. One of the things that the Federal Reserve has done by raising those short-term rates is caused mortgage rates to go up.
Right.
Mortgage rates tend to run loosely in line with the yields on the 10-year U.S. Treasury bonds that we talked about at the end of the first segment. Those are now up around 4%. And typically, 30-year fixed rate mortgage will be between 1.5 and 2 percentage points higher than that yield. So in a normal market, we'd be looking at a mortgage rate today of about 5.5 to 6%. Instead, because of the risk and the volatility that the market is pricing in, because they're not sure what the Federal Reserve is going to do next, we're looking at mortgage rates for a 30-year fixed rate loan of over 7%. The most recent numbers from last week from Freddie Mac, we were at almost 7.2% on that average 30-year fixed rate loan and 6.5% on a 15-year fixed rate loan. And you and I were talking before the show, and historically speaking, if we keep these things in context, we're still actually below the 25-year average, which was 8%. But we have a whole generation of home buyers who've come of age during the period of the lowest mortgage rates in the history of the country.
They got spoiled.
And to be clear, it's one of the reasons that home prices rose as rapidly as they did and got as high as they are, is because you could afford to make monthly payments with a 2.5%, 3.5% mortgage. Now you still have home prices about as high as they were then, and you have a mortgage rate that's doubled. And for most home buyers, particularly first-time home buyers, that meant your monthly mortgage payment was going to go up by 45 to 60%. And most of us didn't get that 45 to 60% raise last year. So it really had a huge impact on affordability. In fact, this is such an unusual occurrence that according to Freddie Mac, it's the only time in U.S. history when mortgage rates doubled during a calendar year. And they didn't just double in a calendar year, Keith, they doubled in the space of a few months. So it was that kind of systemic shock to the system that really hit the housing market as hard as it did.
Right. And they've also nearly tripled in a pretty short period of time.
Yeah, they really have. And again, going back historically speaking, and I get this from Gen Z folks and millennials when I talk about, the old days of mortgage. And I do remember my first mortgage had 2 numbers to the left of the decimal point. I forget if it was 11 or 12%, but it was something like that. And they basically say, okay, boomer, but that 11% mortgage was on your $70,000 house.
Right.
And not, today's median priced home of $430,000 or whatever it is. So it's a fair point. Mortgage rates are not high historically speaking, but that cost, that monthly cost, because of the combination of home prices and higher interest rates, is choking some people and making affordability a problem. And because of that, one of the forward-looking metrics that I take a look at is the Purchase Loan Mortgage Application Index from the Mortgage Bankers Association. So this is the number of people that are applying for loans with the purpose of buying a house. They're off almost 30% on a year-over-year basis right now. And so you can see without straining your eyes at all the impact that these higher mortgage rates are having on the housing market. And we had almost record numbers of purchase loan applications from the time people were allowed out of their house during the pandemic until these mortgage rates doubled from 2020 through the early part of 2022, as mortgage rates were in the 3s and 4s and sometimes even in the 2s.
Yeah, everyone wants to talk about mortgage rates, and it is an important discussion to have. Here at GRE Marketplace with our investment coaches, Rick, some builders, as you know, they commonly offer rate buy down incentives to buyers of new homes. And what some of our providers are doing here, Rick, is we have one builder where if you use their preferred lender, they're buying down your income property's mortgage rate to 5.75%. And we have another builder where if you use their preferred lender, they're still buying down your mortgage rate to 4.75%. And of course, with non-owner occupied property here, previously you had talked about mortgage rates in excess of 7. They might normally be about 8% for non-owner occupied property, but you're able to buy them down to 5.75 or even 4.75 with one of our providers for new builds right now.
That's a great deal, and your listeners should really be taking advantage of those opportunities. We'll get into new homes in a few minutes and what we're seeing builders do for consumers. But I have to tell you, those numbers are better deals than consumers are getting right now. And you're being generous when you're talking about private lending rates right now. Most of the lenders I'm familiar with are 9, 10, 11%, depending on the nature of your investment. So your folks are getting a great deal with those rates. We talked about purchase loan applications. The other advanced predictor I look at is pending home sales. These are people that are entering into contracts, but the deal hasn't been closed yet, hasn't been recorded yet. This comes out from the National Association of Realtors. And those numbers are down on a year-over-year basis as well. There's a lot of rate sensitivity in the market, though, Keith. And if you go back to March, when rates went down just a fraction of a percent, we saw more purchase loan applications, we saw more pending home sales. But as rates have climbed back up over 7, we've seen both of these metrics go down.
Yeah, so we're talking about pending home sales. We're talking about sales volume that's down in this discussion, not sales price. And Rick, I know it might be hard to say, but when you see sales volume that's down, including pending sales, how often is that due to worse affordability? And how often is that due to low supply of homes?
Why don't we jump right into that, Keith? That's a great segue into the next handful of slides. And this is a very difficult time in the housing market because it has both of the factors that you just mentioned. Two very difficult headwinds for the market to try and overcome. And because of that, and we'll get into details on both of those in just a minute, because of that, existing home sales were down in July, and they were down pretty significantly on a year-over-year basis, about 16%. And that's the 23rd consecutive month where existing home sales were lower than they were the prior year. And in fact, January was the lowest month of sales this month. And it broke a streak. Last year, I was forecasting that we'd see between 4.3 and 4.4 existing home sales. That's down from about 5.2 last year and about 6.1 million the year before. Right now, we're trending at a little over 4 million existing home sales for the year. So even my relatively low forecast for the year may have been overly optimistic. You mentioned inventory, and inventory is a huge headwind for the market. Inventory of homes for sale today is down about 9% from where it was a year ago. It's down 47% from where we were in 2019, which was probably the last normal year we've had in the housing market. In a normal year, we would be looking at about a 6-month supply of homes available for sale. That's what economists or housing market analysts will look at as a balanced market, balance between supply and demand. We're at about 2.5 month supply right now nationally, and in many states, it's much lower than that. So there's just not much out here. And the only reason the inventory number looks as good as it looks, and it doesn't look very good, is because it's taking a little longer to sell properties once they hit the market. If you were looking at new listing data, it's even worse. There's very little inventory coming to market in the way of new listings, and that's because of the rate increases we talked about a minute ago. 90% of borrowers with a mortgage have an interest rate on that mortgage of 6% or less. 70% have an interest rate of 4% or less. If you're sitting on a mortgage rate of 3.5% and you sell your house and buy a house at the same exact price with a 7% mortgage, you've just doubled your monthly mortgage payment. It's not that people psychologically don't want to trade a low rate for a high rate. There's a financial penalty for them doing so. And until we see mortgage rates come down a bit, probably into the 5s, we're just not going to see a lot of inventory coming to market, except for homeowners who need to sell or have so much equity and maybe are going to downsize into a smaller property that they don't care about that kind of shift.
Yeah, that is the mortgage rate lock-in effect, perfectly explained. And the Fed, with their raising rates, they can crimp demand. But one thing that the Fed cannot do is create supply. As much as you might like to see Jerome Powell in work boots with a nail gun, that just doesn't happen.
There's an image for your listeners, Keith. Yeah, and I'm not sure I'd want to live in that house that I saw Chairman Powell building, but
Get an inspection.
yeah, good economist, maybe not a carpenter. We were talking about this a little bit earlier too, and if you're an investor, this is probably worth noting. Whether you're a fix and flip investor or an investor who's buying properties to rent out, a lot of the interest. This is from sharing some data from Realtor.com, and they've taken a look at where people are searching for properties and where transactions are taking place. And they're finding that Midwest, Southeast are really the hottest markets, places that are a little off the beaten path, places in New Hampshire and Connecticut and Maine and Ohio, and Wisconsin. But interestingly, some of the markets that had been suffering a little bit, they're starting to see a little more interest in, whether it's California, but off the coast, or markets in Colorado or Washington State. But clearly, a lot of the activity, a lot of the money is moving into the Midwest and Southeast.
That's right. With the work from anywhere trend, you might see this small flattening and not as much of a disparity in home prices between markets. You're certainly still going to see that, but that can just help create a mild flattening when it doesn't matter where you live anymore, and you can go ahead and purchase in lower cost markets.
Yeah, and the what I'm sharing now is national home prices, home price appreciation. And I'm glad you mentioned what you just did, Keith, because the fact of the matter is this has been a very localized correction. And if you're in San Francisco or San Jose, if you're in Seattle, if you're in Austin, if you're in Phoenix, you're in markets where prices are off 10% or more from peak. If you're in Boise, Idaho, you're off more than 10% from peak. But Boise had home prices go up by 47% in a single year, a year or so ago. So it just overshot the mark. One of the reasons the national numbers don't show more volatility is because of what Keith just mentioned. It's because people are trading in where they are in a high price, high tax state, moving into a lower price state, and candidly outbidding local buyers and probably overpaying a little bit for those properties. So you're seeing home prices go up in some of those less expensive markets much more rapidly than they would under normal circumstances.
Yeah, and what we're talking about here is national home prices that are appreciating at a modest rate now.
Yeah, and they are. So if you look at whether you're looking at the Case-Shiller index that gets published monthly or the National Association of Realtors data, we saw home price appreciation start to go down last year. It was still positive, but going down. And that was true until pretty much the end of the first quarter this year, when the NAR data went negative for the first time in years. So we were seeing on both a month-over-month and year-over-year basis, home prices go down. And that happened until June. June, things flatlined. In July, prices actually went up year over year. So if you were looking at the median home price compared to the peak price a year ago, it's actually up about 1% from where we were last year, which is kind of amazing. The Case-Shiller index is a little bit of a lagging indicator, and it rolls 3 months together, but it also started to turn the corner with its July report. So after almost a full year of price appreciation coming down and prices in decline, we've seen both of these indexes turn and are starting to go positive. And it does show you that there continues to be demand for properties that are brought to market. And while home price appreciation certainly isn't soaring by any means, it's back in positive territory now. And that's something that a lot of people hadn't predicted this year.
When the supply of homes is this low, it keeps generating a few bids for any available home. Now, not as many bids as it did back in 2021, but besides generating bids, you have these huge population cohorts of millennials and Gen Zers that are growing, and they're in their prime homebuyer years, moving through the system to go ahead and place those bids and keep just modest home price appreciation here lately. That's sort of how I see it, Rick. If you want to add any color or thoughts to that.
I think you're spot on, Keith. It's the largest cohort of young adults between the ages of 25 and 34 in U.S. history. That's prime age for forming a household. 33 to 34 is the average age of a first-time buyer right now. And so these people would like to buy a house. And for people who are investing in single family rental properties in particular, at least short term, the affordability issue is something that definitely works in your favor. If somebody was looking to buy a house, they might prefer to rent a house rather than rent an apartment. And I've read research that shows somewhere between 20 and 30% of people who had planned to buy have decided to rent for the next year or two while market conditions settle down, or while they can put aside more money for a down payment. So I think these market conditions are playing in favor of people who have rental properties to offer. One other metric I'd like to share in terms of home prices, Keith, is the FHFA puts out its own index. FHFA is the government entity that controls Fannie Mae and Freddie Mac. So these are your conventional bread and butter, vanilla kind of 30-year fixed rate loans. If you look at their portfolio, home prices are actually up 3.1% year over year. And every sector of the country is showing positive price appreciation, except for the Pacific states and the mountain states. And those are some of the markets we talked about earlier. And even those are very close to breaking even at this point.
So FHFA breaks it into about 10 regions, 9 of those 10 currently appreciating year over year.
Yep, something like that. And important for you to know, again, as an investor, is as to what's happening in your region. Again, whether you're planning to sell the property or rent it out. You had talked about what builders are doing for your investor folks, Keith.
Yeah.
We're seeing new home sales actually improving to consumers as well, for a lot of the same reasons. The incentives. A lot of builders are coming to the closing table with cash. They're paying points on mortgages and getting those rates down, whether short-term or long-term. They're offering discounts. They're offering upgrades to properties. And so new home sales are still down, but just slightly on a year-over-year basis, and have actually been beating last year's numbers for the last 4 months. My original estimate for new home sales this year was about 600,000. I think we're going to probably come in closer to 675,000 this year. And the only reason we won't sell more is because the builders aren't building them fast enough. But one of the reasons people are buying these new homes is because that's what's on the market today. So people that would have bought an existing home can't find one. Here's the other factor. New home prices are down 16.4% from last year's peak.
Now, this is informative. Yeah. I think this would surprise a lot of people. Well, it surprises me.
Well, and it should surprise people because new home prices almost always go up, right? This does not mean builders are discounting homes 16.4%. What's happening is they are building less expensive homes. They're less expensive per square foot, and they're building smaller homes. And they're doing that in acknowledgement of the higher cost of financing. That also, by the way, is incenting people to look at these properties as, either a starter home or a minor move-up kind of property. But it is one of the reasons why new home sales are doing better than existing home sales right now on a percentage basis.
That's an interesting number, Rick. A few weeks ago, I shared with our newsletter audience that builders are building homes smaller and closer together, which might be reflected in lower prices, but I just didn't think it would be 16.4% lower.
From peak. Now, if you're doing year over year, it's probably not that big of a drop, but from the peak price, we are off. And it is, to your point, it's a pretty significant number. It would be a problematic number if it was the existing home market.
Right.
Because then you'd be looking at the same property being worth 16% less. But a builder can kind of play with those numbers a little bit.
Though Rick and I talked about how this is a good market for investors. In some markets, cash flow has become like an endangered species. Well, I have some really good news for you here. We have largely solved that problem at GRE of higher mortgage rates hurting your cash flow. And that's why investors like you are still snapping up rental properties from GRE Marketplace. Because of the strength of our marketplace network and the relationships that we have here, we have a new build provider offering a mortgage rate of 5.75% to investors. Yes, they will see that your rate is bought down to 5.75% in today's environment. And another new build investment property provider is offering a rate buy down to 4.75%. Yep, you heard that right. We have another builder provider where our investment coaches have been sharing with you a 2.99% seller financing option. These builders are in business to move property, so take advantage of it if you can. And besides buying down your mortgage rate for you like that, some are even waiving their property management fee for you for the first year in addition to buying down your rate. And I don't know how long all of this is going to last. So it can be a really good time for you to contact your GRE investment coach. Your coach will help you shop the GRE Marketplace properties, tell you where the real deals are, and tell you how to get those improbably low mortgage rates for income properties. And your coach guides you and makes it easy for you. And if you don't have an investment coach yet, it is truly free. Go direct to gremarketplace.com/coach, and they're there to help you out. GRE Marketplace properties, you're going to find those properties somewhat less expensive than elsewhere. And that's in addition to those low rates from providers. But why are the properties often, but not always, lower? Well, first of all, investor advantage markets just intrinsically have lower prices than the national median. And secondly, there is no real estate agent to compensate with the traditional 6% commission. You are buying directly. And thirdly, these providers are not mom and pop flippers that provide just like 1 or 2 homes a year here and there. Instead, these are builders and renovation and management companies, and they're in business to do this at scale, so they get to buy all their materials in bulk, and that keeps the price down for you. And another reason that you tend to find good deals at GRE Marketplace is that you aren't buying properties from owner occupants where homeowners get their emotions involved. So you can go ahead and get started with off-market deals at gremarketplace.com. And if you'd like the coaching from our investment coaches, contact the same coach that you've already been working with. They are credentialed professionals. They have their MBAs. And really, more importantly, they're active investors just like you. And if you don't have a coach helping you yet, you can go straight to gremarketplace.com/coach. I'm Keith Weinhold. Thanks for watching. I'll see you next time.